Hola mi gente, welcome back to Latino Investor, your go-to channel for all things money and investment related within the Latino community. So I wanted to make this quick video to address sort of the events that are going on this week. This week we saw that the major indices in the US dropped significantly, such as the S&P 500, the NASDAQ 100, the Dow Jones. So what is causing this big drop? Is the stock market crashing, or is this just a correction? Well, let's take a look at some of the forces that have been driving the market down this last week. So unemployment data came out last week on Friday, showing that unemployment rose to 4.3%, a number that we haven't seen since October of 2021. In addition, we saw that the US added only about 114,000 jobs, which is far below the average of 215,000 jobs in the last 12 months. So this has investors worried that the US economy is starting to slow down and that there's more economic downturn in the future. Another big event has been the unwinding of the yen carrying trades going on for a while. So what is the yen carrying trades? The yen carry trades have three big steps. The first step is that you borrow yen at a very low interest rate, meaning that borrowing yen relatively had very little cost. So the second step is to take the yen and convert that into US dollars. Now, once you have US dollars, this leads to the third step, which is to convert those US dollars and invest them into something that is making money. For example, putting that money into stocks, as well as US treasuries and bonds. These have been paying a higher interest rate ever since the US Federal Reserve has increased rates to combat inflation. This is a strategy that works until it doesn't. So what do I mean by this? Well, there's a few ways how this can go bad. First is that Japan could increase rates, and then the cost of borrowing yen could get much more expensive. Second is that the assets that you're buying start to go down in price. Now, what's going on is a combination of both. Recently, the Bank of Japan has announced that they've increased their interest rates to 0.25, which means that borrowing yen is not as cheap as it once was. And even though the interest rate of 0.25 isn't much bigger, when you have a lot of money, it is a lot less money that you're making on your profits. Second is that with the US economic data coming out last week, there's fears that the Federal Reserve is going to have to cut interest rates, meaning that the spread between borrowing the yen is going up and the profits that you're making from your assets is coming down. Now, with the combination of all the economic data going around, not just in the US, but also in global markets, causing the stock market to go down this last week, what does that mean you should be doing with your money right now? Does that mean you should be changing your investment strategy? For me personally, I'm not doing anything different. Why do I say that? Well, it's because time in the market is much more important than timing the market. To further explain my thinking, we need to take a look at a study done by Fidelity. In this study, Fidelity compared the growth of a $5,000 portfolio from 1980 to 2023 in different scenarios. So your $5,000 would have grown to $5.5 million if you were the best investor of all time, meaning that you always bought the market at the absolute low every single year and you invested every single dollar at that time. Now, the second best scenario was the scenario of investing all $5,000 at the beginning of the year. This would have yielded $5.1 million over that time period. Now, the third best scenario was investing that $5,000 over the 12 months. This would have yielded $4.8 million. If you absolutely had the worst luck and you always bought the market at the very top every single year, you still would have made a whopping $4.2 million and you bought the market at the top every single year. Now, what was the absolute worst decision you could have done? Well, the absolute worst decision you could have done is stayed cash. We can see that if you would have stayed cash, this would have led to you having an overall balance after that time period of about $350,000. So what do these scenarios tell us about investing? Well, it tells us that buying the market at any time is really a better option than staying cash. So mi gente, the plan stays the same. I'm going to still contribute $2,000 every single month and buy the market, as I've mentioned in my previous videos. Now, these $2,000 I have broken up into $500 every single week. So $500 every single week is taken out of my savings and contributed to my investment accounts, which I then use to buy more of the indices. So I'm not letting these short-term fears affect my long-term strategy. Entonces, mi raza, if you want to stay updated with what I do with my portfolio, as well as watch me grow my wealth over time, go ahead and subscribe to all of the channels, as well as hit the like and subscribe button so that you don't miss any of our future content. And remember, raza, hay que echarle ganas para salir adelante. Let's achieve financial freedom together. Hasta la próxima.